one other aspect of this, as you know, when the banking crisis this time took off, SVB went, Signature went, Credit Suisse went, then there was a wobble at Deutsche Bank, which seemed to be then reassured by the European Central Bank. But then in the meantime, First Republic in the United States, that was, merged, forcibly merged. It's almost like you're trying to guess where the next one will pop up. Do you think that guessing game is yet over, or is that yet another phase of what might happen as a result of this tighter liquidity?
So our observation is that those tight liquidity conditions are still in place. It may be that we see more institutions come under pressure. The Federal Reserve, by putting in place some of the facilities they have, has probably alleviated some of the near-term risks. But I think at the time they're reminded that banks run on confidence. And of course, as soon as that confidence goes, their ability to do business, which they need to do every single day, becomes impaired, and they can very quickly lose access to markets. They can lose deposits in the case of something like SVB Bank, and then it's game over. So, and the other issue, of course, that the banks have is that they're competing for deposits in a high interest rate world, and customers can access high interest rates in the money market through cash management funds, through treasury bills themselves, and so their cost of funding has gone up enormously. And the consequence of what's happened in the US and what's happened in US, rumours around Deutsche Bank as well, generally seeing this cost of capital in bond markets for banks has been moving higher, and so that's another headwind as well.
And yet, the central banks can't do much about this while they're actually trying to fight inflation. So they can't have it both ways in some ways, because that's ultimately what higher interest rates are all about.
That's exactly right. And to our mind, what are central banks trying to do? Well, they're trying to make the price of money more expensive, and they're trying to slow the creation of credit in the economy. And so you could observe that these events are, in a sense, consistent with what they've been trying to do. They don't want to see institutions fail or a loss of confidence in the financial system, but this is a natural outworking, to our mind, of what central banks are trying to do in create a tighter lending environment. So, in the one hand, taking with the left hand and giving back on the right hand through balance sheet management. Let's not necessarily call it quantitative easing, but effectively injecting liquidity through other measures whilst they're raising interest rates. That only goes so far. The markets are very much entertaining the view that we are fairly close to the end of this tightening cycle. And so I think the likelihood that they're raising interest rates and at the same time easing liquidity through other measures for an extended period is probably pretty low.
Yeah, Andrew Canobi, the head of fixed interest at Franklin Templeton here in Australia. Many thanks for your time on the program today.
Thanks very much, Ross.